In the first full week of June, three of the world's central banks, the ECB, the Bank of Canada, and the Bank of Denmark, cut interest rates, potentially signaling the beginning of a global coordinated easing of monetary policy.
Are we today moving into a dialing back phase? I wouldn't volunteer that.
All of the banks had similar statements to accompany the eases, as they assured markets that these eases were not pushed by panic and that any further cuts are currently not planned and depend on incoming data. But is the US going to be close behind? Well, there's two things that challenge that narrative. EU's inflation rate had fallen to 2.4% in April of 2024, significantly lower than the 3.4% in the US. And the latest read on non-farm payrolls in the US came in much higher than expected, with the economy adding 272,000 jobs versus expectations of 185,000. Now, despite a relatively tame US PCE number on May 30th, inflation is still a major domestic concern. Analysts note the rapidly rising national debt and, more importantly, the historically high 120% debt to GDP ratio in the US. Now, the next US CPI read is on June 12th, and expectations are for another 3.4% print. If the number comes in significantly lower, perhaps that could be enough to pull forward rate cuts from the Fed alongside the rest of the world's central banks.